The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and welcome to Investor Expos show for July 9th. My name is Anna, and I'll be your host today. We are having a great lineup of 3 speakers for you. Michael Valtos, for the first time on our show, Sid Norris, and Jason Love. This session will be recorded and sent to your email. Please take a look at your GoToWebinar control panel. Into the questions box, you will be able to ask any questions you want during the speaker's presentation. So let's begin and bring to the show our first guest, Michael Valtos. Good morning, Michael.
Unmuted.
Good morning, Anna. How are you today?
Perfect. How is your day going so far?
It's good. It's good. You know, it's summer's here, and we're about halfway through it, and I'm enjoying it. I'm enjoying being able to go outside and things like that.
Always love your presentations. What are you planning to share with us today?
Well, today I got a special presentation. I'll be talking about order flow techniques that work. You know, everybody always wants to have strategies that work in the market, and I'm going to be sharing some of my my favorite strategies that I use on a regular basis every day in the market. So, hopefully people can come away from today's presentation with a good understanding of things that they could apply to their trading and how to read the order flow.
Sounds great and exciting. I will get back to you in 45 minutes.
Okay, great. Okay, let's make sure my screen is showing okay. Looks like it is. All right, let me just get going here. So, hey everybody, welcome to today's presentation. My name is Michael Valtos from Orderflows.com, and today I'll be talking about order flow techniques that work. You know, we all want to have ways of trading the market that work, and today I'm going to be sharing a few of my strategies that I use on a regular basis, things I look for every day in the market. So, ask yourself, as a trader, is this you? Are you trying to put a square peg into a round hole? And what I mean by that is, are you losing money? Are you doing things that just don't work? You can't put a square peg in a round hole and expect to be successful at trading. Now, what you're going to learn today is I'll be talking about 3 different topics. One, what separates order flow from other market analysis. I'll be talking about how to successfully trade order flow. And lastly, I'll be sharing with you order flow techniques that work. These are techniques that I use daily. I'm always looking for these setups, these patterns, if you will, in the order flow. So for those
Michael,
that are new,
Michael, just would like to remind you that please follow the questions from the attendees, and could you please make to play your presentations, because I can see the other slides too.
Okay, I put it on the slideshow here. I thought I had it on. Okay.
Looks great.
Is that better now? Yeah, for some reason I was having a bit of a problem with this PC for some reason. But anyway, it should be okay now. Okay. Alrighty, so let's just see if we got any things here. Okay, so for those of you that are new to one of my presentations, again, my name is Michael Valtos, and I've started this company called Orderflows.com in 2015. Okay, so that's what we're going on about 5 years already. And what it is, it's a order flows software as well as education company. But prior to that, I've had 20 years in institutional trading at the highest level, right? I spent 8 years as vice president of futures trading at JP Morgan. I spent 4 years as a futures trading desk manager at Cargill. I spent 3 years at Commerce Bank as a Eurex trader. I spent 2 years at EDF Man as a global macro trader, and I spent 3 years with Dean Witter. I started on the CME floor as a runner. which is, basically the lowest level that you can start in the business. And you just, you don't have that level of entry nowadays that you had before. And so by starting my company, it was a way for me to give back the knowledge that I've gained over the years that people can apply to their own trading. And like I said, in 2013, I left JP Morgan because I wanted to spend more time with my family. I wanted to trade for myself. Trading does give you that freedom. You don't have to be a slave to a 9 to 5 job. You can go out there, you can live your life, you can do your trades, and if you're good at it and you can make money, that's what can um, provide for your standard of living. And I wrote a book. It's called Trading Order Flow. And if you stick around to the end, I'm going to give you a copy of my book, Trading Order Flow. Now, with the orderflows.com, I realized that the trading software out there that looked at order flow wasn't good enough. And I wanted more from the software. I wanted the software to do um, analysis for me rather than just present the data there for me. Computers are there to help you understand what you're looking at in the market. So I met with a programmer who understood order flow, and we created the Orderflows Trader software. It runs on NinjaTrader 8, and what it is a volume footprint chart with 7 pre-programmed order flow indicators. And the charts, the reason I talk about this now is because I want you to understand the charts that you're going to be seeing in this presentation are generated specifically from the Orderflows Trader software, which runs on NinjaTrader 8. Now, a brief disclaimer, please understand that trading involves risk, and you shouldn't be trading with money you can't afford to lose. So the first topic I'm going to be talking about is what separates order flow from other market analysis. And again, this takes us back to the basic question, why do most traders lose money? Well, from working with a lot of retail traders over the last several years, and I found that working with retail traders as opposed to trading in an institutional environment is completely different. Retail traders mainly focus on one part of the market, and that one part is just price, right? They only focus on price, and to me, that's the big problem. Now, if you remember yesterday in the E-mini S&Ps, we had a big move down. We had a big 30-point move down from the 3162 area down below 3130, and move happened relatively quick in about an hour. Okay, and as a trader, these are those moves that you love to catch. You love to catch the big 20-point move, the big 30-point move. But oftentimes, people get in well after a move has started. So let's just take you through some ways that people that focus on price get into the market. And I'm going to show you how people that look at order flow get into the market. So, okay, price action traders, right? They're going to see a lower low, lower high, lower low, and then the break of the lower low, they're going to get short. Okay, that's fine. Fortunately, this was a big enough move that there was a lot of profit that could be had, right? If you're getting short around the 3150 area and covering around the 3130 area, that's great. That's a nice 20-point move. But remember, the move started above 3160. You just gave up 1/3 of the profit potential. Head and shoulders, classical technical analysis pattern. And it's very similar to the price action, the lower low, lower high, lower low. You have your two shoulders, you have your head, you break the neckline, again, coming in around 3150. By the time you're breaking 3150, everybody in the world is seeing this market breaking. So, while it's not a bad trade to take, again, ask yourself where you want to be short from. Do you want to be short from 10 points lower? Now, if you're into Fibonacci, right, you had a nice 50% retracement here coming in around the 3156 area. You could have got short there and, caught a nice move down. So, all of these forms of technical analysis, when the market is trending, they're all going to kick off nice sell signals because there's so much juice, so much meat on the market that no matter how you get into the market, you can make money. And this is sort of one of the, I don't want to say downfalls, but one of the ways that traders get lulled into the market is when you have a nice big move, anything you throw on your chart is going to make you money, right? Again, this is the plain candlestick chart, the move starting at 3162 down to 3130. maybe you're into trend lines. Okay, you got all this spaghetti going on your charts. One of them's got to work. There was a nice one coming up, probably around the 31, right in that box. The 31.56, 31.58 area. That's a better entry. But then again, if you were short from earlier, you would have been stopped out on a bunch of trades, right? Because the market did rally up from 31.40 all the way up to 31.60 before falling over. And then there's later breaks again around the same level, around the 31.50 area, 31.48 area that everybody in the world is seeing. Okay, but again, by that point, you gave up an extra 10 points. Now, order flow was very bearish up near the high that was being put in around the 31.60 area all the way up to 31.62, areas in that box up there. And this is what the order flow volume footprint chart looks like, right? What order flow does is it takes what's being traded on the bid and the offer and it puts it into a nice, easy to read format so that you could decide, is this market strong? Is this market weak? And this is especially important because anytime a market is at a high of the day, you want to be asking, is this market strong? Meaning, are we going to go higher? Or is this market exhibiting weakness? Meaning, this is the high, it's probably going to hold. I should be looking to get short. Any shorts that I take, I know exactly where my stops are. They're going to be just beyond the high of the day, or even right around the high of the day. You can have a much tighter stop with order flow than with traditional technical analysis. So when I'm looking at this high that's being put in yesterday, and I see, I put the red arrows there so you can see the bars that have multiple imbalances. And I'll be talking a little bit more about imbalances a bit later, but when I hit the high, I see selling coming in. We hit a new high, a point and a half higher. More selling imbalances come in over the next couple bars. That's bearish, right? Because what is happening? The market rallied to a high level, and sellers are being attracted into the market, and not just people. Yeah, I'll throw in an offer here. No, these are people that are hitting the bid. These are selling imbalances appearing at the high of the day. Now, second part that made this high so appealing, given a low risk trade opportunity, is after hitting the high, just about all the deltas in the bars are negative, meaning there was more aggressive selling in the bars than aggressive buying. And that's important as well, because it's one thing to have just imbalances, selling imbalances up at the high of the day. But when you hit the high of the day and the market is just sort of going sideways, but overall there's selling occurring, right? What's happening? Everyone talks about accumulation and distribution, but they don't really get into it. When you see at the highs of the day, you're going sideways, but you see overall negative deltas, that's a sign of distribution. That means there's supply in the market. People are happy to sell at these high prices. Now, remember, right, if you got to think as an institutional trader, somebody that's sitting on a big inventory, in this case, we'll call it, this is E-minis, this is a 1 minute chart. Market is going up, right? You don't sell, if you're an institutional trader, you're not looking to sell as the market starts going down, even though you will participate. But as the market is going up and it hits a high and it's just sort of staying around that high, if you can sell as much as you can at those high levels without moving the market, that's a great sell. If you're an institutional trader, if you're a big trader, you want to sell as much as you can without moving the market. And what people get lost on is they don't think like an institutional trader, and I know this because I speak from experience having to trade big sizes at the banks, is as the market is rallying, that's your opportunity to move size, right? If a market is dropping and you're trying to sell a big position, you're just adding fuel to the fire. You're helping the market go down. But if a market is rallying, going up, that's the most easiest time to sell out a big position. And as you can see here, right, these are the individual bar deltas, right? They're all basically negative. You have a few bars that are positive in here, You know, you got one bar with a 250, one bar with 130, one bar with 97. You get that last minute pop, that last pop up before the market falls over of strong delta 1558. You know, people is trying to just see if we can take this market any higher, maybe trigger some stops, maybe trigger some programs coming into the market. They make that push. It doesn't. They immediately turn sellers. Boom. Delta just expands, and the market falls over. Now, another part of order flow is what I call the internal deltas, right? It's the max delta, the min delta. And what the max delta and the min delta is, well, let's start at the beginning. Delta is the difference between net aggressive buyers and aggressive sellers in the bar. Max delta tells you how positive the aggressive buying was at one point in the bar, you know, how its strength. Min delta tells you the strength on the weakness side, you know, how weak it was in the bar. And you can see we're right up here at our highs of the day. And the max delta, as you're skimming along the highs from the high to this new high before it falls over, you had very relatively small max deltas, you know, 99, 200, 300, 100, 200, 150, 35, 100. Again, before that bar with the, you know, where it just pops up. But you're at your highs of the day. Where's your buyers? Right? You don't see them in there, right? You should be seeing positive deltas. You know, on this move up, just the bars preceding this area where you went sideways, you're seeing positive deltas 400, 500, 900. Then you're at your high. You only got 100, 200. You know, that's a sign of weakness, right? Because you don't have that big, strong, aggressive buying in the market anymore. Now, another extra clue is you're at your high of the day, excuse me, and just before 9 o'clock, you've got cumulative delta. Now, cumulative delta is the total strength in the delta or the total weakness in the delta throughout the day. So, you know, think of it as, you know, you're always adding or subtracting to the cumulative delta. So you hit your high at, you know, 859. Okay, you made the new high the first time. It's got a cumulative delta of 11,216. Okay, now we trade sideways. Cumulative delta is getting smaller. Boom, you make the new high. Cumulative delta is 11,013. So it's a difference of about 200 contracts, but you're making a new high. Well, when you're making new highs, you should be making new highs. A sign of a healthy market is new highs on stronger cumulative delta, not weaker cumulative delta. Because from their initial high here, we had at 859, cumulative delta of 11,216. And then over the next 12, 13 minutes, it went down from 11,000 to 9,400. So, you know, that's almost about a close to a 2,000, over 2,000 contract swing. You're still around your highs. So what's that telling you? There's a lot of selling, a lot of aggressive selling coming into the market. Even though the market is basically going sideways, it's not selling off. It's because, you know, people are buying from these aggressive sellers. Then boom, you get the one bar where you poke up, positive delta. But again, the cumulative delta is still negative, is still lesser than the first time you hit the high. And then it just starts dropping off again over the next couple of bars. So hopefully by now you can understand, you know, how order flow can get you into the market a little bit faster, right? It's going to get you in up here. It was that area I was showing you on those order flow charts is this 3160 area. So it's telling you the market is pretty weak up here, right? Again, if you're at the high of the day and you're looking to short, you know, around the 3160 area, your high is 3162, you got a 2-point stop more or less. And look at the potential, right? As opposed to, you know, getting short off of trend lines, off of a price action, getting short at 3150, you know, head and shoulders again, 3150 trend lines, you know, Fibonacci, you know, the 3155 area. You're getting a minimum of an extra 5 points on your short of profit potential. And more often than not, you're getting, you know, 10 points extra on that move. So how to successfully trade order flow? Well, what's the goal of trading, right? it's to make money. We're not in here to say I'm the smartest person in the room. No, you want to make money, right? You want to have a good life. And that's how you keep score in the markets. But to be successful means you're making money consistently. And this is where a lot of traders struggle, is consistently. Now, in order to trade successfully with order flow, you have to understand what the data means you're looking at. It's like driving your car. You got all these little gauges. They each mean a different thing. My wife, she's a good driver, God bless her, but she doesn't understand what a lot of these lights mean. And all she's focused on is the speedometer, not even the gas gauge, but RPMs, forget that. But she wouldn't know that, hey, the car needs oil unless I sit there, unless I see the light come on and say, hey, the car needs oil. Can she drive? Yes, she can drive. She's a good, excellent driver. But when it comes to taking care of the car, basically like taking care of your trading account, you got to understand what you're looking at. Okay. Now, order flow is about understanding what the aggressive traders are doing in the market. Now, that doesn't mean that's all order flow is about. There's other things about order flow, but sort of the main focus on order flow is determining what the aggressive traders are doing in the market and what they're doing right now. So this is a dome, right? We're all familiar with, the depth of market, the price ladder, okay? And you have passive buyers, people that sit on the bid and below, and passive sellers, traders that are on the offer and above the offer. For a trade to happen, an aggressive seller has to sell to a passive buyer, or an aggressive buyer has to buy from a passive seller. And when that happens, when an aggressive seller sells to a passive buyer, that registers as -1 in the delta, and the volume is printed on the footprint chart on the bid side at that price. If an aggressive buyer buys from a passive seller, that registers as +1 in the delta, and that one contract that traded, or 5 contracts, that will show up on the offer side of the footprint chart. Okay, so earlier I was talking about delta and imbalances. Again, delta is the difference between aggressive buyers and aggressive sellers in the bar. An imbalance occurs when there are more aggressive buyers versus aggressive sellers in the two-way auction, right? Most trading that happens, there's no imbalances, okay? Majority of trading, I'd say about 90% of the trade, is just your normal market facilitation, buyers and sellers transacting. But there are times when there's an imbalance of buyers or an imbalance of sellers in the market. So within order flow, there's 4 types of delta numbers you could look at. There's the delta, which is sort of like the headline delta, which is the final delta in the bar. When the bar at that snapshot in time, what the delta is. Max delta is how strong positive delta was at one point in the bar. Max delta is how strong negatively delta was in the bar, meaning how much selling, the max selling in that bar at one point. Cumulative delta is sort of your running delta total for the day, plus or minus. So final delta, it will appear along the bottom of the bar. Okay, you can see at the bottom here, some people call it the basement. But you can see there's delta, max delta, min delta, cumulative delta, and I also have volume up there. So delta, again, tells you the delta for the bar. So you can see here at this low at 945, it's got -51. So it's telling me when this bar closed, there was net selling in the bar, -51. The next bar has positive delta of 176. It's telling me when the bar closed, it had positive delta, more buyers than sellers by 176 contracts. Okay, so max delta, let's just take a look at these 2 bars again. Max delta in this red bar at 945 is just 7. So it's telling me at the strongest buyers were in this bar was just 7 contracts over net sellers. Okay, it can't, max delta can never go negative. The lowest it could go is 0. The next bar, max delta, this big green bar at 946, it had max delta of 182. So it's telling me this bar had 182 more buyers than sellers at one point in this bar. Okay, now min delta, again, those 2 bars, min delta is how strong sellers were at one point in the bar. So again, at 945, this red bar had min delta of -134. meaning at one point the net sellers outnumbered the net buyers by 134. The next bar, it was just -9. Min delta can never be positive. The highest it could go is 0. Now I'm not going to get into, I've got some other videos on YouTube about the relationships between the max and the min delta numbers, but these are good numbers to tell you when a market is turning. Now cumulative delta, it just is sort of the running total in the delta. So when a bar closes, like you can see here at 945, the max delta, the cumulative delta is 4681. Then the next bar, it closed with a delta of 176. So you add the 176 to 4681, cumulative delta got bigger to 4857. Next bar, 69 was the final delta. 69 plus 4857 is 4926. Then as you get into negative, you subtract from the previous bar. That's your cumulative delta. There's ways to use cumulative delta in your trading as well, but that's a whole nother webinar. Now, imbalances, they occur when there are more aggressive buyers versus aggressive sellers in the two-way auction. Remember, markets trade in a two-way auction. 31.10 and a quarter bid at 31.10 and a half. But when you have, say, more aggressive buyers trading at 31.10 and a half versus 31.10 and a quarter, by a certain ratio, most people use 4-to-1. Okay, which is, it's a good level to start at, but again, it's not set in stone. The minimum I suggest is about 3-to-1. I know some people that use 10-to-1. Again, it's a personal choice, but the average, the industry standard is about 4-to-1. Okay, that's my default starting number. And not all bars have imbalances. Now, how it looks on a footprint chart, right? Again, the footprint chart plots the volume traded at each particular price in a bar. Now, there's going to be black numbers, red numbers, and blue numbers. Blue numbers, as highlighted by these blue arrows, are buying imbalances. Selling imbalances are the red volumes. Now, normal order flow is the black numbers inside the bars. And again, some bars have no imbalances. Some bars may have both the buying and selling imbalances. But generally, when you have green candles, that's where you're going to see buying imbalances. When you have red candles, generally that's where you're going to see selling imbalances. But again, there's no absolute in there. Now, with buying imbalances, the way you can start to use them is you look for certain patterns in the imbalances. So, for example, a stacked buying imbalance, okay, is a bar that has 3 or more buying imbalances stacked neatly on top of each other, right? And a stacked selling imbalance is the opposite. It's a bar that has 3 or more selling imbalances stacked neatly on top of each other. 1, 2, 3, 4 here. Here you've got, on this buying imbalance, you've got like 8 buying imbalances in a row. Oftentimes, you see them being caused by stops. You see them being caused by big traders coming in and sweeping the market. And sometimes you just, everybody decides to get long or get short at the same time. There's different reasons for them being caused in the market. Now, my Orderflows Trader software takes it a step further, and we highlight the bars that have what I call multiple imbalances. So on a green bar, it's going to be 3 or more buying imbalances. On a red bar, it's going to be 3 or more selling imbalances. So you can see here on this chart, there's no stacked buying imbalances. Instead, what you have is multiple buying imbalances, multiple selling imbalances. And it puts a pink box around. It's actually violet, but it looks pink. And this is important because it's highlighting to you areas where traders are being aggressive in the market. And I'll be talking about this in the next section. As a trader, you want to be seeing areas where traders are aggressive in the market, where there's aggressive buying coming into the market, where there's aggressive selling coming into the market, because you want to take advantage of it. So, the last part I'm going to talk about is order flow strategies at work. Now, I look for these strategies every day in the market. I cannot open a chart and not look for these strategies because I know that over time they've made me good money, and there's no reason for me not to look for them because I know that when I see these patterns, these strategies appear in the market, I know that the market has a tendency to go in that direction. Now, Again, please note, right, when you trade, don't trade in a bubble, like analyzing one bar and one bar in isolation. You got to look beyond what that one bar is doing to understand sort of, the market overtone going on in the background, right? Is the market trending up? Is the market trending down, or is the market going sideways? If the market is trending up, and think of it like the tide, okay? There's, the tide in the ocean, right? It comes in, spends all day coming in, and spends the rest of the time going out. And you have individual waves coming in at the same time. And, if you're going to go surfing, or go swimming, you know that how to time in when you're going into the water, right, by the waves. You're not necessarily concerned with the tide, but, if you've ever spent time at the ocean and the tide's going out and there's a big wave going out, you can find yourself sucked out further from the beach than you want to be. So take market context into consideration when you're taking trades. Just don't take trades blindly because, oh my gosh, here's a stacked buying imbalance. I gotta take this trade. Understand how it's being, why it's coming in at the market at that time. So the first pattern, the first setup I want to talk about today is the multiple imbalances. Okay, now what a multiple imbalance is, I just talked about it briefly, but it's 3 or more buying imbalances in an up bar, a green candle, or 3 or more selling imbalances in a down candle, a red candle. Again, take it in context of the market. Don't just blindly buy every bar that has a multiple imbalance or sell every bar that has a multiple imbalance. Multiple imbalances differ from stacked imbalances and they're spread out in the bar. Now, we've had this in our software for many years. As far as I know, we're the only software that has it, the Orderflows trader software. And what it is, again, is you can see here with this blue arrow, you see this pink box coming in. That's telling me I have 3 buying imbalances in the bar. Just as these red candles have more than, you have the pink box around it, they've got, more than 3 selling imbalances in there. And again, you can adjust, say you don't want to look for just 3. Say you want to look for bars that have 5. Okay, you can do that. Say you want to look for bars that have just 2. Say you want to look for bars that have imbalances, but not 4 to 1. Say you want to be a little bit stricter. You say, I don't know, I want to use 10 to 1. You can do that. You can adjust that. It's flexible in that sense. And again, when I say take them in context of the market, this is yesterday morning, or in the E-mini MES, right? The 1 minute contract, the 1 minute chart. MES is a great contract for trading because it gives you skin in the game. A lot of brokers have, the initial margin is like $1,200, but a lot of brokers have day trade margins of $50. A tick is worth $1.25. And it's a good way, if you want to get out of sim and sort of put real money in the game and get a feel for the psychology that goes along with trading, it's a great way to get involved in the markets. And yesterday, after we hit our low here at 31.25.5, the market started creeping back up. And then as we started creeping back up, I could see aggressive buying coming into the market in the form of buying imbalances. And they're spread out. Again, if you're looking for stacked buying imbalances, you don't see any on this move. You're going to miss this entire pop up. So imagine you're getting long here at 31.31. It makes a quick move all the way up to the 31.37 area. That's a quick 5-point move in just a couple of minutes in the MES. Okay, so here's bonds. This is yesterday as well. This is a 5-minute chart. Okay, people say, why you jump around between 1 minute and 5-minute chart? Because if you're looking at a 1 minute chart of the bonds, it's basically oftentimes it's trading bid in the offer for 1 minute. You got to expand it a bit. And I want to show you, I look for the same things, whether it's a 1 minute chart, whether it's a 5-minute chart, whether it's a 4 range chart, whether it's an 8 range chart, whether it's a 500 tick chart, whether it's a 5,000 volume chart. You're looking for the same things in the order flow. This was the bonds yesterday. We popped up to this high. We got a bar with multiple selling imbalances. You see no stacked imbalances in here. Some people, they write strategies, they sell you software looking for stacked imbalances, and they're missing this whole thing of multiple imbalances. You still have aggressive sellers coming into the market. They're just not neatly stacked on top of each other, and multiple imbalances are important. And you see you got a nice move down there in the bonds. And, a little bit later in the bonds, after we sold off, we made a move back up. What do you got? You got multiple buying imbalances signaling to you, hey, aggressive traders have stepped in here, and boom, the market puts in a nice rally. This is crude oil. This is a 1-minute chart yesterday, right after the high was made at 40.78 at just before 8 o'clock in the morning. What do you got? You got a bar with a 1-minute chart, 1, 2, 3, 4 selling imbalances. Then 2 bars later, another bar with selling imbalances. This was a quick 20-cent move that you could have had in less than 10 minutes in the crude oil. Euro currency. So again, it's a 5-minute chart. We're just right around our highs of the day, just sort of sitting there. But as you're at the high of the day, what do you see? You see some bars with multiple buying imbalances. But again, this is why I talk about taking things in context of the market. Okay, you're at your high, you see aggressive buying coming in. That's what you expect to see. But when you're at your high and you see aggressive selling coming in, your ears should prick up. You should say, okay, what's really happening in this market? I expect to see aggressive buying coming in at the highs, and you do see it. Now, but you also see aggressive selling coming into the market. Okay, what do you think is more important at the highs, aggressive buying or aggressive selling? Well, if it was just aggressive buying with no aggressive selling, okay, maybe the market could go higher. But if you got some aggressive buying, but you also have aggressive selling, it's telling you that there's sellers up here. We're at a high price. We've attracted sellers into the market, and they're interested in distributing their supply. So, we're up here for 30 minutes, and you're seeing 1, 2, 3 bars with aggressive selling before the market breaks from 56 all the way down to 40, to the 30s. So don't just focus on the obvious stacked imbalances. Look for areas on the chart with multiple imbalances. They're just as important. And again, as a trader, right, you want to have an edge over other traders, right? You want to see things that they're not seeing that you can take advantage of. And I'll be honest with you, very few traders look for multiple imbalances. I know some successful traders, that's all they look for is bars with multiple imbalances and trade around them. Okay, so the next setup I want to talk about is the delta surge. And what it is, it's a steady increase in directional delta over several bars. And again, it's best taken in context of the market. Don't just buy every delta surge that's a buy or sell every one that's a sell. Take it in context of the market. As the market is starting to move, that's where it's going to be, in my opinion, strongest. Now, this is an indicator. It's for free on my website, orderflows.com. You just got to, click on the button that says download the delta surge. It's only for NinjaTrader 8. And it's not available for any other system, just NinjaTrader 8. But what it is, this is MES rather. It's a 1,000 tick chart. And you can see here, just around 12, just after 12 in the afternoon yesterday, you had a delta surge appear. You got a 10-point move down. You're coming up to this sort of the swing high coming in around the 31.48 area. And then you see the sellers stepping into the market, the aggressive sellers. You can see some imbalances appearing in the bar with the surge signals, even the bar before it. But you can see here, I circled the box. You can see the delta getting it's positive 33 at the high. Then it becomes minus 67, minus 94, minus 700. That's your cue to, if you're in a position, get out and start to get short. Okay, because this move up is over. The sellers have come into the market and they're in control right now of the market. Again, it's the MES. This is a 1-minute chart. Okay, right after the high was made, this was earlier in that day yesterday, just after the high was made at 9:12, 9:13. Again, you're at your high and you see aggressive sellers coming in, and you see it in the delta. It went from positive 1600 to minus 82, minus 304, minus 942. The market kind of went sideways before it just fell off the cliff, right? Dropped down into the 30s. But again, as you're in this sideways action, there's nothing in the order flow telling you to get long. It's all negative. It's all selling. It's all negative deltas, right? Here's crude oil. This was a quick move. Hit a swing high around the 74 area, 40.74, and then a delta surge appeared. It went minus 12, minus 35, minus 131. then a quick 15-cent drop from the 60s down into the 40s. This was gold yesterday. It's a 1-minute chart. Again, you hit your swing high around the 1828 area. Delta surge appears. Market sells off from the 26 and a half area down below 23. Again, and that's within less than 10 minutes. The delta -6, -20, -59. And again, if you're not using NinjaTrader and you can't get this indicator, you can just look at the delta on your chart and see that. All right, you can see the delta is getting stronger or negative, more negative. It's hard to find buys yesterday because pretty much all the markets were down. But you can see here, you get for a buy, it would be the opposite. It would be 6, 20, 59. Here you see -6, -20, -59. Now, the beauty of having this indicator is it will work on normal candlestick charts as long as you have NinjaTrader. And again, you can see this is that MES yesterday, right? Yeah, there was one signal earlier around 7:45. It didn't work. Then you got that monster signal at about 9:15. Then you got a smaller signal a bit later around 1 o'clock in the afternoon. Here's wheat, right? This is a market that was rallying yesterday, rallied into the night session. And you can see, there was, a buy the day before, didn't really work, a buy around the close. Market went up, a couple sells. First one, couple cents. Next one, no, stopped you out. Nothing is perfect. Okay, if anybody's going to sell you a trading system that guarantees 100% trades, it's doesn't exist. Either that or you're going to have super wide stops and take tons of heat that most people can't sit through. But you can see how this market is moving higher and higher and higher as it's as the delta surge is building on itself. So hopefully by now you can see how order flow analysis provides advanced information that you need to gain an edge over other traders. You want to see what's happening in the market. So hopefully by now you can see how powerful order flow is, right? Don't overcomplicate trading. Trade what's happening right in front of you. So if you're ready to add order flow trading to your analysis, I've got a special deal for you. But there's two ways you can do it. One, you can try and figure all this out on your own. You can spend years looking at a screen trying to figure out order flow. And more importantly, you could waste more money trading. Or two, you get the education and software from a trader who has successfully traded order flow at the highest levels. You can skip that massive trading losses, skip the wasted time. And order flow gives you the most current information available to a trader. It's not some indicator, it's just the market, right? It's not based on pivot levels, it's not based on Fibonacci, it's not based on Elliott wave, MACD, or not VWAP. It's what is trading on the bid, what's trading on the offer. Order flow is the market. So there's the order flow trader software, right? It runs on NinjaTrader 8. And again, all the charts I generated in this presentation are from the order flows trader. It will run on the free version. So if you don't want to spend money for the paid version of NinjaTrader, you could run it on the free version. But having order flow software is one thing. You have to know how to use it. I don't just give you the software, send you on your way. I provide a lot of education. I just got an email from somebody yesterday who bought one of my trading courses. It says, I bought this other software, but there's absolutely no education that goes with it. And each week, I do a private live group training session just for users. Okay, so far there's 80 recorded sessions. And so it tells you how long this goes back. Some people will charge you extra for this, right? There's some people charge $200 a month for additional training. I give you this for free. You can go in there, you could ask questions, I'll answer them. I'm in there every week. I'm also going to give you access to the order flow trading course, which normally I sell for $297. I'll also give you access to the Inner Circle video series. There's additional 56 videos on order flow tricks, tips, and analysis. So you put this all together, it's already $1,600, $1,700. But as a special bonus, because of investors, Expos keeps having me back, I'm going to give you access to my favorite course, the Order Flow Playbook. That's pushing $2,000, but you're not going to pay that, right? And I don't want you to spend more money than you really need to be. People think that the value of an indicator is how much it's worth. Like the more it's worth, the better it is. No. You got to read what's happening in the market. A lot of people say very good things. Here Sheila says, your order flows trader software is remarkably helpful. I can clearly see now who's in control of the markets. So, if you want to be successful, you got to plan, you got to get there. So for a one-time payment, It's just $6.75. You can get my software. All that education is included in it. There's no more payments. You don't have to keep paying me monthly. You don't have to, all you got to pay for is just your data fees that you pay from your broker. So just go to orderflows.com/oft2 and it will take you to the sign up page, right? That you can get started. It looks like this, the page, right? Just scroll down to this button that says buy now. I want this. And it's processed by PayPal. I don't get your credit card information. I don't want your credit card information, right? Now, if you want my book, just go to orderflows.com/book.html. I just checked the link out. It does work. So you enter your name, email, and click submit. It will take you to that page. So go to orderflows.com/off2 to get started, right? If anything in life, you got to get started. You got to get up off your butt and get going. So anyway, I'll put the link in the chat, or actually, I'm not sure she got it in there, but the book is orderflows.com/book.html. Make sure you put the HTML on the end. If you're interested in the software, go to orderflows.com/oft2.html. This is a different offer than what's on my website. My website one, it's a more expensive offer, but this is the oft2.html offer is a very good offer to get started on trading order flow. All right, Anna, I'm going to throw it back to you now. So thanks for having me, and thanks everyone for that time of your day.
Thank you so much for the great presentation. We had all the links into the chat box. As always, pleasure having you on the show, and have a great rest of your day.
Thanks, Anna. Bye-bye.